100 baggers. Everyone wants to have one, a stock that goes up 100 times, but not everyone knows the characteristics these stocks have in common. That's what the book 100 Baggers by Christopher Mayer goes over. And in this video, we're going to review why this book is a must-read for anyone interested in fundamental investing. The author of 100 Baggers was inspired by an older book he had read, written by Thomas Phelps, 100 to 1 in the Stock Market. And Chris has compounded on the insights found within that book using historical stock data from Compustat, which goes as far back as 1962. It's incredibly important to study the best performing investors or stocks and see what led to their success, and that's exactly what this book does. In the updated findings, there were 365 stocks that went up 100 times from 1962 to 2014. That was after the author accounted for outliers like mining stocks that got lucky finding a great mineral deposit by chance. So we're not talking about unrepeatable moonshots, only about quality companies. All the 365 stocks outlined in the book are in the appendix, with some examples being Northrop Grumman up 907 times, Caterpillar up 261 times, McDonald's up 3,983 times, American Express up 317 times, and Merck up 826 times. As you can hear, there is no consistency to what industry these companies were from. They were from all over the board, really. So that's a decent takeaway right there. But in the back of 100 Baggers, there were 10 actual defined takeaways from the research, common trends that can be found in all of these serial compounding companies, and we're going to go over all those points right now. Starting with number 1, you have to look for them. The fact that 365 companies were able to go up 100 times certainly means that it's possible to find them. But that doesn't mean it's going to be easy. According to the Motley Fool, in the over-the-counter markets in the United States alone, there are more than 12,000 listed stocks. Point being, if you want to find stocks with such high upside potential, you're going to have to put in the work. And another part of this lesson was that we'll have to narrow our focus, at least if we have limited time to spend researching. Most people don't have time to look through that many stocks, so some of the other lessons in this list will help us narrow down our options. Moving on, takeaways number 2 and 3 are grouped together and referred to as the twin engines for growth. Number 2, the first engine, is growth in sales and earnings per share. As the size of the business grows and how much money it's generating, then over the long term, the value of the company will theoretically increase as well. It's crucial that any company you buy is run by great capital allocators so they can continue to invest in existing or emerging opportunities that continue to snowball that growth. The focal point of the book is return on invested capital, and once the company sees significant growth, the question is, can they continue to build upon that success in new business ventures? Number 3, and the second engine for growth, is preferably buying the stock at a low multiple. The author mentions that it's preferred because ultimately, to own great companies, many times you're going to have to pay a premium. A lot of these companies tend to trade at rich P's, 30, 40, 50. While we may see them on relative discounts at some points, it's a pretty low chance quality companies will be trading at a 5 PE, for example. Although, never say never. So double-digit sales growth, or at least earnings per share growth, and low multiples are the twin engines for success over the long term. Takeaway number 4 is to focus on finding companies with economic moats. A moat is a long-term competitive advantage that makes it difficult for competitors to take a company's market share. We're looking for moats because, as we'll talk about in some of the other lessons on the list, we need room for significant growth, and we'll need to sustain that growth for a long period of time. There are primarily 5 types of economic moats to look out for. The first is low-cost production. So if a company has the lowest cost product, this is where companies like Walmart excel, for example. The second type of moat is high switching costs. So for example, if you wanted to swap to a different email provider from the one you currently have, you'd have to change your email address for every account you have online. It becomes a huge hassle, so people are unlikely to do it. You want your product to be as sticky as possible for existing users. The third type of moat we can find is network effects. This type of moat can be found in industries where products become more valuable as more people use them. Some examples being the social media sites, online auction platforms, or futures contract exchanges. The fourth type of moat is intangible assets. This refers to patents or trademarks that legally hold competition at bay, or advantages that grow over time like strong brand recognition. Brand's one of the reasons why Warren Buffett loved Coca-Cola so much, for example. And the fifth type of moat is efficient scale. This primarily refers to how capital-intensive businesses can gain an advantage over their competition. One example being Boeing. It would be incredibly difficult for another aerospace company to acquire the funding necessary to compete with them, since Boeing has already spent many billions of dollars on manufacturing capacity as well as achieving government contracts. They essentially have a duopoly with Airbus, their main competitor. So those are the 5 types of moats that we're looking for to maintain the company's dominance over time, which will in turn lead to higher margins and sustained growth. As I mentioned earlier, there were no particular industries that outshined others in producing 100 baggers, but the type of industry a company is in can certainly determine how likely a stock might be to have a strong moat. Looking at the automotive industry, as one example, the sector is incredibly capital intensive, while there's also plenty of competition at the same time. So building a substantial moat in this space can be significantly more challenging. But back to the takeaways of the book, the 5th takeaway was that it was preferable to buy smaller companies. The median market cap of a successful company noted in the study was around 500 million. So the companies don't have to be absolutely tiny, but looking at small caps at least is ideal. As you can imagine, more mature companies are simply not going to be able to grow at the same pace they could when at smaller levels. This is one of the reasons why I personally choose to invest in microcaps, and I showcase that process on this channel, with my own twist on it, since I focus on investing in companies that have strong fundamentals, but will also help the environment in some way as well. Okay, takeaway number 6. A good trait to look out for with these companies is significant levels of insider ownership, a focus on owner-operators. I like to invest in companies where the executive team owns at least 10% of the shares outstanding, especially if the company is small. And we want to make sure the incentives of the people running the companies we're invested in are aligned with our own as shareholders. What's the easiest way to do that? It's to find companies where the insiders are significant shareholders themselves. Takeaway number 7 is the coffee can approach, which speaks to the long-term time horizon that we need to have as investors to actually reach a return of 100 times. The average amount of time it took for a stock to go up 100x was around 26 years in the study. So this requires a lot of patience, and this is why an economic moat is so important as well. The company needs to not only survive, but dominate for decades. The closer a company can be to a sustainable monopoly, the better. We can think of Google with its dominance in the search engine market, or Ticketmaster with live event tickets. Moving on, the 8th takeaway of the book is to filter out the noise, essentially saying to avoid worrying about inflation or other economic woes, whatever doomsday scenario is the focal point of the week, whatever the financial media is losing their minds over. None of this matters in the long term. And even if events cause the stock price of a company you like to drop in the short term, then that's just a buying opportunity more than anything else. So it is crucial to avoid all the distractions that will ultimately be irrelevant. The 9th takeaway is called Luck Helps, essentially boiling down to an idea that a certain degree of luck is always involved in investing. You can find companies with all the traits found in 100 baggers, and they could certainly still end up failing. It's always a possibility. But we're placing the odds in our favor if we position ourselves as best we can. We want to position ourselves to get lucky, and ultimately we have to leave the rest up to the companies to prove themselves. The 10th takeaway from the book is that you should be a reluctant seller. The author quotes Phil Fisher from his book Common Stocks and Uncommon Profits as follows: "If the job has been correctly done when a common stock is purchased, the time to sell it is almost never. Selling after a stock is up 30% ensures you'll never have a 100 bagger, obviously. The coffee can approach also brings tax benefits, as it delays paying capital gains if you rarely sell." So those are the 10 takeaways from the book. And like I mentioned in the beginning of the video, I think 100 Baggers is a must-read for every investor, new or not. Many of the lessons in this book are ones that I've incorporated into my own strategy. If you're interested in the book, I'll have an affiliate link in the description, where any purchase through clicking on that link will benefit the channel, as I will get a portion of that sale. Thanks for watching.